Do you use multiple time frames?
Welcome everyone to Traders of the World, our new interview show where we bring inspiring stories about the financial market and incredible guests. I am Matheus Massari and I am extremely excited to be here. With me, I have Flávio Lemos.
Hello world, good morning, good afternoon, or good evening, wherever you may be around the world. I'm Professor Flávio Lemos, chairman of the Brazilian local chapter of the CMT Association and also author of some investment books. We are speaking English because we want this show to inspire new traders around the world. I hope you all like it and subscribe to our channel.
Great. I'm certain that we have an amazing conversation with our guest. Speaking of our guest, after graduating from Merrimack College with a BA in business management, he worked for a small brokerage firm before landing as a stockbroker at Lehman Brothers in Boston. While at the firm, he was exposed to technical analysis, which he quickly discovered was a valuable tool for market and selecting stocks. He was lead trader and director of the research at MarketWise Securities from 1999 to 2006, where his focus was providing technical analysis, training, and education. Around that time, he began blogging educational posts about trading, and he is also a CMT member, right, Flávio?
Yes, he is. And he is the author of two great books, Technical Analysis Using Multiple Time Frames and Maximum Trading Gains with Anchored VWAP. He believes that multiple time frame analysis is one of the keys to finding low risk and high probability trade candidates. The other book is focusing on price movement using the volume weight average price, the VWAP, coupled with the Anchored VWAP, which is in detail in his latest book.
In 2010, he expanded his focus by launching the website Alphatrends.net, providing stock trading education to traders and swinging trading ideas to subscribers. Please welcome Mr. Brian Shannon.
Hello, Brian.
Hello. Thanks for having me here today.
You are welcome, and thank you so much for being here. Brian, so tell us about your beginning career at Lehman Brothers. Up from the start, what did you learn to do and not to do there?
Okay, I started right out of college at Lehman Brothers in Boston, and at Lehman Brothers, prior to being there, I had a little bit of success in high school and in college with a couple of stock trades that I had done, and I wanted to be a stockbroker based on that experience. Little did I know that being a stockbroker meant cold calling all day and harassing people on the phone, trying to get them to open an account with you. So I learned a lot there in terms of how to sell. I got a good broker, senior broker that I worked with who had a good strategy of buying companies that reported positive earnings surprises and then looking at the charts of those to increase his odds that he would do well for his clients. And he did do well for his clients. So I was lucky in that regard to be exposed to his way of doing it. And I really started picking up on technical analysis there. What I learned is that I don't like to be a salesman, but I want to be a trader. So I kept being a broker for about 2.5 years, and it was a great experience because not only did I learn how to sell, I also learned a little bit about the market and how it worked, so that when I did leave and become a full-time trader, I basically had 2.5 years of full-time, daily market exposure to give me a head start on the learning curve for professional trading.
And Brian, a question that we always ask here in the show: what is your best and worst trade, and what have you learned with it?
Yeah, the worst trade, I think I've spoken about this one before. Probably, well, when I moved to Denver in 1993, and probably about 5 years after that, I was working at a firm trading prop money. And I used to sit next to this guy who would come in every single day. He'd come in at 10 a.m. Eastern, and he'd just look for whatever stock was down the most, and he would start buying it. And he would buy 500 shares every half a point down or whatever. I thought he was insane for doing this because I was making good money at the time, buying breakouts, stocks that are moving from, short-term uptrends to longer-term uptrends, and just being patient, skilled, disciplined, and, using my market knowledge. So I saw him do this probably 30 days in a row, and he'd make $5 to $10 grand every day. Meanwhile, I was plugging away, making $2,000-$3,000, and I was pleased with that till I saw what he was doing. So every day he'd say, "Brian, you're going to buy with me today. You're going to buy with me today." So now I'm not going to I can't do what you do. And then one day he finally, he walked in. I said, "Hey, Darren, here's the stock we're buying today." He goes, "We? Really? You're going to do it with me?" I said, "Yeah, I'm going to do it." He was actually buying 1,000 shares every point down. I decided to do 500. I said, "Yeah, I'm going to do 500 every half a point down." Probably 3 hours later, I had 13,500 shares of a stock that was down significantly. I don't remember the exact numbers, but it was obvious to me that, this wasn't the one that was going to bounce. And, in a way it was good because I knew I shouldn't have been doing it. I did it. I got burned, and then I moved on. So I don't remember what the exact dollar number was. It was, mid five figures, maybe $35,000, or I really honestly don't know. But because it's so long ago that I learned, stick with what I do. I puked the position out. Unfortunately, it was a good thing because it was a biotech stock, and it continued to go down for months, actually, and ended up putting that guy out of the business, in fact, because he never sold it. So I learned a couple of things. One, stick to what you know. Two, biotechs in particular, when they get hit hard because their science is maybe changed or, isn't proven, and those don't bounce back the way a lot of stocks might bounce back. I'm not interested in playing bounce trades to this day, but in particular with biotech stocks. So that was absolutely the worst. Not too soon thereafter, I don't think it was my biggest, but it was my most memorable because it was my first time that I'd made six figures in a trade. And that was actually just after 9/11. So after 9/11, I had identified a number of stock called Visionics, VSNX, Identix, I think it was called, IDX, and some names that made sense for a more secure world. So, they all gapped up. I waited 2 to 3 days. They pulled back. I bought a big position. I remember going to my manager saying, "Hey, I'd really like to make a big play on these things." He said, "Okay, go for it." And, about a week or so later, I cashed out with six figures. I thought I was a hero. And, that was the most memorable up and down.
That's great. That's great.
Yeah.
So, Brian, how multiple time frame technical analysis could be used together for lower risk and higher probability trades? Do you have a checklist? Which tools specifically do you look at? Would you give me some examples?
Yeah, sure. I mean, I can share the screen too, and we can go that way. It's always better to kind of see exactly what we're talking about, being that technical analysis is about looking, right?
Yeah.
And what we see. So let me just make sure I got this shared properly. And here we go. So is that there? You are presenting your screen. So
Yeah.
what we're looking at right now is two time frames. This is the S&P 500, the SPY, and on the left is a daily time frame. I've got a red 20-day moving average and a blue 50-day moving average. I've got this purple line here, which is the anchored VWAP from the March low, which yesterday it closed right on it. Today we flushed through it. And so one of the big things when I talk about the anchored VWAP is I always talk about, I don't want to buy the touch of the anchored VWAP, because sometimes it'll give the illusion that maybe that's the proper place to buy. Instead, I want to buy as it rallies away from it. So I didn't buy yesterday, and that would have been right at this point. So on the right, we have the 30-minute time frame. This was yesterday right here. So I didn't buy because we were in a downtrend all day yesterday, and there was just no point in playing guessing games. This morning, we opened on a little gap higher, sold off, and now we're right back basically to where we were. And this is the week to date volume weighted average price we're at right here. So what I'm looking at when looking at multiple time frames, first of all, on the daily time frame, I'm looking at this level saying a pullback to a significant anchored VWAP, such as the March low, often will provide support. So we've come down really hard. We ask ourselves, where have we come from? Well, we just came from 452 down to 426. We dropped 26 points, 5%. Where does the market have the potential to go before it might encounter a source of demand that becomes support? And to me, that answer was this anchored VWAP. So that became my level of interest to say, okay, I'm not going to buy the pullback. I don't buy the dip. That's just a waste of money, right? You're just endlessly buying into a pullback. So instead, I look to the shorter term time frame and say, I want to find evidence that the buyers are in control. And even with this rally we've just seen in the last hour and a half right here, to me, that's not the evidence, because one, we ran right into the week to date volume weighted average price. But more important, this orange line is the 5-day moving average. And when the 5-day moving average is declining, I look at that shorter term time frame as it's still guilty until proven innocent, meaning that any of these bounces are likely to just be bounces until proven otherwise. Now, let's set up the scenario for what might happen here. We've got 45 minutes left in the day. I don't think we're going to get a huge rally off of this, but maybe tomorrow we gap up and do something like this. And that's tomorrow. We pull back. And then on Friday, we maybe do this. What that would do is we would then, these were 5 days ago, and this was 4 days ago. So that 5-day moving average, in other words, would start to look like this and then start to look like that. So what I would be looking for is this transition on the shorter term time frame to say, now we've got that 5-day moving average flattened out. And then the next day, if it rallies up like this and does that, well, then maybe Tuesday of next week, we would see the buyers back in control right here. That's the higher high above the flat to rising 5-day moving average. So I'm not playing these guessing games trying to buy down in here. I want there to be an uptrend emerging on this shorter term 30-minute time frame. And then I want to buy strength with my stop under the most recent relevant higher low. That would be right there. So if I buy here and set my stop under there, two things can happen. One, I get stopped out. It goes below there, and that's the end of that. Or two, it rallies up and begins to make a nice steady uptrend. And then it maybe does this in a couple days. And as soon as it makes a new lower low, so we've got this pattern of higher highs and these higher lows. Once that is violated right there, that becomes my exit point. So if I'm trading based on what I see is a bounce trade on the daily time frame that could maybe bring it up towards there, this is how it would potentially look like on the shorter term time frame. And if I'm buying this short term uptrend, I want to hold it as long as the trend is intact. The trend, once established, is more likely to continue than reverse. Higher highs and higher lows is the definition. So if it makes a lower low, by definition, I'm no longer a trend trader if I'm still holding if it breaks that higher low. So that's my cue to get out.
So you prefer your top, you think the top best multiple time frame strategies are to buy on this pullback when it gets back to this anchored VWAP, this I think this orange line.
The orange line is the 5-day moving average, and that's kind of my guide, my number one guideline for an intermediate term time frame, where I have conviction that things can hold. Now, the last time I had conviction was right here on this day. I was long that day. I got long in the morning. I took a third off up in here. The next morning, it gapped down. I got out right there, and then I went on Twitter and said, "Be really careful, because from failed moves often come fast moves." That was this day right here, and it looked like, we had this higher low. It looked like we were going to go on and maybe go back up to that direction. Instead, so it didn't work. I took a third off there. I took 2/3 off there, and I made it was a very small loss, and it was a great loss to take because, one, I took a third off up there, reducing my cost basis down to somewhere in here. So it was a tiny loss, but rather than holding it, and then going down, 20 points from there, that would have been a disaster. Instead, I started switching to the short side over here, and now I'm anticipating the potential for a turn coming, but it's not quite here yet. That's a good sign, this little pop today. But again, look at where it came from. It just rallied in 30 minutes from 422 to 427. So it rallied 5 points. Where did it have the potential to go until it was likely to encounter supply? I look at the week to date volume weighted average price, and that makes sense. So I clearly wouldn't want to be a buyer up in here. That's chasing. So instead it does this, rallies up, starts to build out for a potential, sustainable rally for at least a swing trade sometime early next week.
Nice. And how does your squeezy dynamic theory work? Can you show it in action?
The short squeeze, is that what you said? Short squeeze dynamics? Well,
yeah.
Unfortunately, where the market is right now, I don't have a very good example of a short squeeze. I can say, though, that I just got long this stock yesterday, INSW. Here, if we look at first, we'll look at a weekly time frame right here. And, the weekly time frame, we saw that this prior resistance held as support right along the rising 10, 20, 30, and 40-week moving average. So that's when I look at it and say, it's got potential to continue to move higher. Now, I don't know what the short ratio is in here. I probably should have looked for this one, but I didn't consider it necessarily a short squeeze candidate. Let's assume, though, that there was a short position. What I like to look at is, where are the shorts? Let's say they added from here to here, they added 2 million shares. From here to there, they added 4 million. And here to there, they added 6 million. So now let's say that we have 14 million shares. Well, what I want to know is, what's the volume weighted average price from that first 2 million shares? So what we're saying is, if they added 2 million shares in here, then the volume weighted average price there was 45. Okay. That's their average short sale position. Now, if we say, how about where they added 6 million shares from here to there, right? So if we're talking about this, they added 6 million shares, then their average price is right here. And then if we take a look at from, that point forward, and I think I said 2 million shares there. So in this range, they added 2 million shares, basically right at that price. So we know that these guys are right on the brink of feeling pain who shorted into this, right? These guys are underwater by a pretty good amount. And these guys who shorted maybe that rally are now feeling like, hey, this short isn't really working well. So it tells me we have a potential source of demand here from those short sellers, that once the stock starts giving them pain, well, they're either going to try to short more and hold the stock back, or they're going to go to cover the stock. And if that's the case, what does that mean for me as a swing trader? Well, if they're short, their average short is at this point, let's just say 42.50. We've just, held support in that area. That's where the 50-day moving average is. Now, if we take a look at the volume weighted average price from this peak, well, from the highest point paid, from this point, the highest point paid this year, the average price is 41. From this point, it's 44. So the buyers are in control on both of these time frames. And that tells me the shorts are going to be feeling some pain. So then I want to look at the shorter term time frame. And this is what I did with this one yesterday, was to get involved as it broke this little level right here. So it's in a longer term stage 2 uptrend. We had a stage 2 uptrend over here, stage 3 distribution, stage 4 decline, stage 1 accumulation. And this is what made it stage 2 in the near term. So I want to participate in stage 2. I want to exit stage 3. I want to avoid stage 4 if the primary trend is higher. I don't want to short it because the primary trend is higher, and I assume it's just a pullback. As it starts to turn sideways, that's where I start to anticipate the trade setting up. I set alerts. I look at it a couple times a day. It makes that higher high beyond the high of the last 2 days. That's where I got involved. I sold some initially right up in here. have 2/3 left, and my stop is just under this level right now. So it would give me confidence. So I don't have a lot of confidence in this market, basically, in these trades. It was a smaller size trade simply because we have this going on in the S&P 500 right now. This isn't a good environment for longs. But if I see a stock that I like, I'm still going to participate, but with smaller share size. And right now, again, my stop is under here. That's the most recent relevant high or low since I got.
Of course, you want to know more about the VWAP. How they work, who uses them, what did you discover using it?
Yeah, well, so the VWAP is for 1 day. When we look at a chart and we talk about the VWAP is for today. So this purple line right here in this stock, that's the volume weighted average price for today. So starting from that very first piece of information, you see that dot right there. That dot is the actual volume weighted average price from that first period of data. So what we're doing is we're taking all of the shares traded and the amount of shares and getting the average. So the average at that point on that first 2-minute candle was right here at this price of, what am I trying to do? The actual VWAP for the first 2 minutes was right there at 44.74. That was the average long. That was the average short. That was the average price that the stock traded at. Well, the next minute or next 2-minute candle and next two 2-minute candles, prices were higher. So of course, what happens? Well, that volume weighted average price starts to rise as well. It's a cumulative volume weighted average price that's represented just like a moving average. It is a moving average because you introduce new data to it, the average moves, and it's represented on here. So what we're looking at when we do that is we look at the data and say, now I know at certain points. So for instance, let's just go back to the S&P 500 on that. Let's go on the 30-minute time frame, and we can say here, what was the most recent big event? Well, the most recent big event was the Federal Reserve announcement right here. So the average price since then is right up in here at 431. So what that tells me is the average buyer after the Fed is losing money. The average short is making money. I could also do that. This red line that's from the beginning of the month. The volume weighted average price from the beginning of the month is right up in here. So the way I look at that is if we pull back, if we pull back in here tomorrow and then rally up, maybe we make it through that 5-day moving average, like I said, but then we rally up to this. I think that's probably going to halt the prices, pull back down. And then I want to know what's the average. If this is in fact a meaningful low, I want to know the average price from that low. So if it pulls back tomorrow and it looks like this, and maybe that becomes support, and then it's also this prior resistance. So we're starting to build the structure and say, if it bounces, if it rallies up, pulls back to that volume weighted average price off the low, rallies up into here, pulls back, then what's happening, this 5-day moving average flattens out. Now we have this little band of resistance right in here. And then maybe Monday or Tuesday of next week, we make the higher high above that flat to rising 5-day moving average. That to me says, what's my next level of interest on the upside? Well, maybe closing that gap. That's also where we would see most likely this September month to date volume weighted average price come down and hit. So it's about putting all these pieces of the puzzle together and saying, measuring from the most important points, such as, again, that the thick blue line erased, but what that thick blue line is right here. We'll just make it purple. That's from the beginning of the year. So that's the volume weighted, that's the average price that short sellers got involved. It's the average price that longs got involved. And that right now is right here. Well, it's also tied with this line, which is the 200-day moving average. And it's another important area. So I want to look at this and say, it's not, it's just another piece of the puzzle. If I take a look at the low of 22 to the high of 23 and do a Fibonacci retracement, what do we see here is this is a 38.2% retracement right to this line right here. And traditional support and resistance, this prior resistance was broken Resistance broken tends to act as support. So if we get a bounce and then it rolls back over, I would be shorting with this as a potential level to the downside, not just because of that VWAP, not just because of the 200-day moving average or the Fibonacci or the support and resistance. But to me, I look at it and say, other people, there might be just a Fibonacci trader, and he's looking for that 38.2% to become support. So he covers his short down there. Another 38.2% person who's on the sideline says, that's where I want to buy. Same exact psychology with the 200-day moving average. But we're saying, hey, we're taking profits, but when it gets to the 200-day moving average, we're going to stop taking profits. And in fact, we're going to not add supply. We're going to start putting in bids there and become buyers. So it's all about trying to look at individual tools like the Anchored VWAP or the Fibonacci or a moving average and try to understand the psychology of what's going on with buyers and sellers in that area. And if we've got a couple of these tools telling us the same exact story in the same area, it's more likely that it will, in fact, become support. Doesn't mean it will be support, but it's certainly an area that I need to be paying a lot of attention to see if the buyers show up and I can find a trade in there to the long side, or if I'm going to cover my short down in there after we get a bounce. So I want to trade a bounce, hopefully. I want to avoid it for a couple days as it goes sideways. What happens there? Well, this 20-day moving average comes bearing down on it. And the volume weighted average price from this peak comes bearing down on it as well. So what's that likely to be a place of resistance? So it's trying to just chunk together these different moves to say, how on the bigger picture does that all add up to make this a big level? Because this is where officially the bull market began, in my mind, because that's the first higher high above the flat to rising 200-day moving average or 40-week moving average over here. That's where, it wasn't the low, but that's where you could officially say we're in a stage 2 uptrend right here, right on that candle.
So you are trying to find the smart money where it is, where the institutional buying were and what they were short. So what are the most common anchor points? Events, daily, beginning of the year?
Yeah. Beginning of the year, significant highs and lows. So this high was important for, confirming off of the 2022 high. That was important for confirming also that this is where the bull market really began. Off of this low right here, off of this low is one I'm looking at, and that's where we are right here, right now. So significant highs and lows. You want to look at earnings reports. So if you look at earnings reports on a stock like this, here's 2 earnings reports. One here. Oops. Delete that one. And one right here. So what does that tell us? Well, from the last earnings report, the buyers were in control, but they lost control right here. However, from 2 quarters ago, the buyers are still in control. So if we come down into this zone, maybe that's going to become support and then rally back up to this level and kind of start to move between those. So, and then I would, of course, add one to this peak right here and say that's going to be important for a bounce on this. And if we come down to this level, then bounce, well, this one and this one will likely be in about the same place. And this 20-week moving average will be coming down at that level as well. So it's about putting all the pieces of the puzzle together and then saying with certainty who has control from this point or from this point. Well, the buyers had control, but they lost it. So that's what, to me, technical analysis is about, is trying to keep it as simple as possible, make it about supply and demand. Resistance broken tends to act as support. That's why that 420 level is important for the SPY. 200-day moving average often acts as support on a pullback. What's the psychology of why? And it's more about understanding the psychology of why those levels become important than just blindly saying, hey, it's at support. People always say, hey, it's at the 200-day moving average. It's at support. And you know, they said that about the 50-day moving average over here. Hey, it's at the 50, it's at support. Well, it wasn't support. It was just a potential level of support that didn't turn out to be too important at that time. So it's not about truisms. It's about weight of evidence in that area. When we get there, I want to see it start to act constructive on these timeframes. And that's still, I mean, if you look at the S&P right now, sure, that's a nice rally, but we have a pattern in here that still, to me, is pretty clear. And that is a pattern of lower highs and lower lows. So maybe we need this first, and then we can say, there, that's a higher low. Boom, that's a higher high. Now take it one piece at a time from there.
Great.
Nice. So what is your personal trader's routine? Could you explain in detail how it works?
Sure. What I do each day, typically around this time, about 1 p.m. my time, which is 3 p.m. Eastern, what I do is I start looking through a large number of stocks. That list being about 250. That's the stocks I look at every single day. I'll look through those 250 stocks on something that looks like this, and I will go through them and I will look at it like this. So I've got, you know, the weekly chart here, the daily, the 30-minute, the 15-minute. Off to the side, you can't see that I also have a 2-minute time frame. So I'm looking at these multiple time frames, and I'm not looking for something in particular. I'm just observing that, hey, we're above we're fighting the anchored VWAP from the all-time high in GLNG. On the daily time frame, how does that look? Well, we saw this rally up, pull back. Now we're in here with the 20 and 50-day moving average coming together. They're both rising together here, and they've seen this little pullback. Well, let's take a look at what that pullback is. So we can look at that pullback on the 30-minute time frame, and we can say, what's the average price from this peak right here? So that peak right there, the buyers are holding above it. We can see that with a little bit more clarity here on this 15-minute time frame. And you can see that we got above it and we held above it all day today. To me, that's important because now this stock looks like the 200-day moving average is flattening out and about to turn higher. To me, this is where tomorrow I want to buy this stock above today's high with a stop under here. So I look at these stocks as they come together and I'm looking at them. So AROC was one for today. It gapped up, so I didn't chase it. AVGO was a short sale, which I got in and got out of. BRZE is another one that I'm not in yet. So I'm looking for ideas. And the next so I do that at the end of the night. And then the ones that I might like the most, I share them with my subscribers at alphatrends.net in a video format. And I explain it kind of as I was just explaining, you know, the S&P and that, saying, here's the logic. Here's what we're looking for. We would buy this stock. Let's go back to GLNG. We would be a buyer of this stock with our stop, though, under here. That's the risk that I'm willing to take. This is a higher high above that flat to rising 5-day moving average. That's the orange one. So if we buy here, buy the higher high, this is the most recent relevant higher low. Now we know exactly what our risk is. If the stock triggers along and then it comes back down like this, what happened to my emerging uptrend? It got destroyed. So that's my risk. Now, what's my potential reward? I think, you know, at least up to here. So in other words, $1.20. And what would the risk be? The risk would be about 40 cents. So that's actually perfect. I didn't even realize that, but that's a 1-part risk, 40 cents for a potential $1.20 the upside. That's a 1 to 3 risk reward. So I would look for it to go up there. I would sell some on the breakout, and then I would hold some to see if maybe it can continue to move higher. That to me, you know, this is where I love to sell some is on the breakout, because you hear people all the time complaining, hey, breakouts don't work anymore. Well, it's because people got involved $1.20 lower, and now they're looking to sell to you. Of course they don't work. But if it does continue to rally, I'm going to still hold a third of it and see what I can get out of it. So that's, you know, that's how I come up with my ideas. I just filter down manually through a large list of stocks that has all kinds of different stocks in it. And I've developed that list over the weekend by going through a list of 900 stocks. So I write those down, and then for the next day, I write down my stocks with my little notes on it, and I have those in front of me. I set a ton of alerts on my software the next morning, and I might say, you know, let's say the stock closes here at 2360 where it is right now. And if I think I want to buy it above 2380, I don't set a buy stop order. I set an alert at 2372 maybe. So as it gets to 2372, I'll put it up in a level 2 screen and start watching it. I'll watch it on the 2-minute chart and see how it's starting to develop. Maybe it gets slammed right back down to 2360. So I'll just reset the alert and then forget about it for now. I'll just keep doing that until I start to observe and say, now's the time to go. 2381, I'm on it. It's time to go for this stock, set my stop, and let the stock work for me. Try not to overthink it. And then the rest of my day, I'm going through these, you know, managing them as, you know, if in the first hour it runs up to 2430, and then it pulls back to 2405, and then runs up to 2435, I'll raise my stop 22 cents under that pullback low of 2405. I'll set my alert at 2403. I own it at 2331. That means now I'm protected. And that's the most recent relevant higher low. So that's why my stop is there. It's not 2%, 5%. It's what's underneath the higher low. At about 11 Eastern, I record a quick video that updates these stocks for Alphatrends subscribers. And I'm, you know, the rest of the day, I'm just resetting my alerts. I'm going through my stocks. I'm, you know, sending out a tweet once in a while, and, you know, the day of a trader, right? Repeat the same thing over and over again.
Of course, I need to ask you this. You work at that Lehman Brothers. So how do you use risk management?
Well, it's got nothing to do with anything I learned at Lehman Brothers.
Thanks.
And that's not really a slam against them either. That, you know, so risk management, as I said, you know, the most important thing is I know why I'm involved in a stock. I know that on a long trade, that the longer term trend is higher. So I want to be long. Now, the question is, I don't want to be long after the stock rallied 10% in 3 days. I want to get involved just as it's starting to turn higher. And that would mean right here. So the first thing I do is I say, okay, if I'm wrong in this trade, what's the place where I would admit I'm wrong? And that is, you know, right here. So if I thought this was an A+ setup, which you could say based on the chart, it's probably an A- setup, but then I have to consider the overall market. So if let's say an A+ setup, my risk would be $1,000, just to keep a nice even number. So that might mean, okay, if my risk is 40 cents, that means I can trade, what would be the number of that? 1,200 shares or something like that. If I risk 40 cents on 1,200 shares, that's, you know, I'm going to lose $1,000. But the market is, so because it's an A-, maybe I just risk $900. I'm still risking 40 cents. So I would be, you know, trading instead of 1,200 shares, maybe 1,080 shares. And what about the market? The market is still below declining 5-day moving average. And to me, that's not the best environment for trades. So I might take this from a A- down to a B- and say, all right, you know, if my B is $500 risk, then I might say, I'm going to risk $400. So if my risk is $400 and I'm, you know, risking 40 cents, well, that's easy. Now I buy 1,000 shares. My math was wrong earlier, by the way. It should have been 2,500 shares. So if my risk is $400, that means I'll buy 1,000 shares of this stock. So that's what's important to me. That's the initial protective stop. What I do is when the stock starts to rally, let's say up to this little high right here, if I buy it at 2380, I'm generally going to sell a third somewhere up there. That's probably about daily R2 as well. So I look to take a third off, and that does two things. It reduces my risk over my exposure, obviously. But if I gain that 32 cents on that first third, what does that do? It reduces my cost basis on the balance by 15 cents. So I no longer own a 2/3 position at 23.81. I look at it as I own it at $23.65 per share. So I've lowered my cost basis by taking that first third off. So instead of having my stop down here, I might put my stop at that break-even point. And then if it pulls back, fine. If it doesn't, well, I'm again going to do the same thing, which is to listen to the message of the stock. And if it starts to do something like this, that it rallies up, I take some off, pulls back a little bit. As soon as it breaks that peak, now my stop goes from 23.65 to 23.92. And then if it does this, and actually right here, I would raise my stop to $24.21. And I repeat that process until this happens. And then at that point, I say the trend that I'm involved in as a swing trader no longer exists. I took a third off with a gain of, what did I say, 30 cents. Now I took the second 2/3 off at a gain of 85 cents per share. On average, I've made 64 cents per share on 1,000 shares. So I made $640. What's next?
Okay.
So it's active risk management to answer the question. It's, I'm not one of those people who believes winners take care of themselves. I think you've got to aggressively manage your risk, especially for a shorter term trade, such as a swing trade time frame, that I want to listen to the message of the stock. I don't want to just make stuff up and say, well, it doesn't feel good anymore. Oh, the market looks like it's pulling back. I need concrete rules to get engaged and also to break off.
And do you use volume as a timing tool or confirmation or rejection of the price direction?
Yeah, pretty much neither, really. I look at volume and I'm aware of what it's supposed to do. But I think that a lot of the time, so what you'll see, on these charts, what's missing is volume. I don't have volume on these charts. I know what volume is supposed to do, but only price pays. So I'm not necessarily interested in the volume. What I'm interested in is the psychology of all of the participants, and that's reflected in that volume weighted average price. So I know it doesn't matter if the volume was big or high or low in here, because what I know is from the highest point paid in the last week and a half, the average buyer is now making money because we're above that point. The average short seller is losing money. So to me, that's more important than, hey, it's down on big volume. But the buyers are in control. Who cares? That doesn't mean anything to me. The other thing I know a lot of people get tripped up on is, they'll be waiting. Let's say the volume looks like this right here as it's starting to rally. This might be tomorrow and it gets a little bit heavier. Then the next day it gets a little bit heavier. Then the next day it breaks out past $25. So the stock starts going like this. And now we're at $25. And then people go, oh yeah, look at all the volume coming into it. Well, if they know anything about volume, volume expands in the direction of the trend. It peaks at near-term turning points. So, if you have volume like this, then it expands in the direction of the trend, peaks at the turning point, and pulls back on lighter volume. And then we see the same thing again. Then we see it go sideways on lighter volume, which is probably what we have going on in here. So it's lonely to be a buyer right here because people will be looking at it going, well, where's the volume? There's no volume. I'm going to wait for volume. Well, if you're waiting for volume, you're also waiting for that upgrade over here at $25 per share, the breakout. And you're looking at things the way people looked at them 20 years ago. That's not the correct way to look at the market. And it's not what helps me. So I stopped looking largely at volume because only price pays, not volume. And it's, if you're going to be a leader and be first to that trend, it's going to be lonely right there. But if you're buying for the correct reason, price reason, volume will come, or you'll get stopped out. And who cares if it's big volume or low volume? It doesn't matter.
Life for a trader is always lonely.
Yeah.
And you said earlier about the Alphatrends. So where our viewers can find your work on social media?
Social media, Twitter is the best place. I have a YouTube channel that I've had for 20 years, and I provide a free weekly video there, but I always post it to Twitter. And if you just follow me on YouTube, you're going to miss all the stuff I do on Twitter. So Twitter at Alphatrends, ALPHATRENDS is how you find me. And that's really the best place. If you're interested in my books, they're on Amazon, and alphatrends.net is where you can learn more about my subscription product, if that's of interest.
And could you suggest some good books?
Yeah, technical analysis using multiple time frames. Maximum Trading Gains with Anchored VWAP by yours truly. Besides that, The Perfect Stock by Brad Kodeshwar. That's a great book. It's a thin book. It reads very easily. It tells you about the trading in Taser, Axon now, back when it had a big run 10 years ago. Fantastic book, just great psychology in there. How to Make Money with Using Charts is another one with great psychology about the technicals. The ones that people always mention, like Reminiscences of a Stock Operator. Let's see, psychology wise, there's several good ones there, and that really is something people don't focus enough on. I would say anything by Brett Steenbarger is worth reading. Ari Kiev has a good one as well. So those are some good ones. The ones that are going to give you the best, I think, are the ones that don't describe patterns so much, but describe the psychology of the pattern, how the pattern developed. And it's not about recognizing heads and shoulders, but why does a head and shoulders pattern, create a reversal? Well, it's just simply, we have a stock in a downtrend. We have this low, it rallies up, it makes a higher low, and then it makes a higher high. And then you look at it and go, hey, that's an inverted head and shoulders pattern. It's just a trend change. We had lower highs and lower lows. Then we have a higher low and then a higher high. That means the definition of trend, which had been lower, is now higher. So understanding things like that is really more important than just memorization of patterns or candlesticks. I paid no attention to candlesticks also.
Brian, talk about your Twitter. There is an awesome tweet about what's the most important chart for anyone.
Yeah.
And you said the one you have the most money in, not the dollar, interest rates, crude, or other things that don't impact your net worth. So considering this, what's your final advice you give to younger traders?
Well, first of all, there's a lot of misinformation out there. And I said that tweet yesterday because, I see things like this a lot. They'll say the most important price is the NASDAQ divided by the Russell 2000. Like, why? Who buys the NASDAQ with Russell? We use, US dollars to buy stocks here. So that doesn't mean anything to me. What's most important is what you're trading. It's me-centric. The most important price is the price that you paid. It's not the closing price. The closing price is useless. You can't do anything on the closing price. It's closed. You're done. You have to wait till tomorrow. How is the price in relation to what I paid for the stock? So what I would say to younger people is be very careful about who you listen to. A lot of stuff gets repeated over and over again that just doesn't make sense. People will say, buy the dip. It's stupid to buy the dip. It's just dumb to do. Why would you start buying a dip over here at 445 and saying, hey, I bought the dip. Great. How do you feel this day? Now you're down 20 points or 5%. It doesn't make sense to buy the dip. And it doesn't make sense to short the rip. So, look at traditional things that people say and don't necessarily believe them. Have critical thinking. Listen to price. Listen to the market. Only price pays. I say that constantly because there's all kinds of people saying things about the economy, about what the Fed's going to do, about what the dollar means for this move or that move. What's important, though, is price action. We trade to make money, and we lose money when price action disagrees with what we do. The reasons, you can find 1,000 reasons from 1,000 people about why the market's going up or down, and not one of them individually matters. Even the Fed gets it wrong a lot. So listen to price action, because that's where all of the prices, all the consensus of current psychology is represented. So learn to read the market, become a student of price action, and try not to assign meaning so much to everything you see.
And we come to an end of this amazing interview with Brian Shannon. We want to thank you all, our viewers, for joining us on this journey.
Brian, I want to say thank you very much for sharing your knowledge and expertise. And we hope that your efforts and dedication inspire traders around the world. Thank you very much.
Thank you as well.
Thank you, everyone. We'll see you in the next interview.